58-year-old Beatrice Ndavi is on a routine tour of her farm. On one corner is what on a good day would be filled with fruit trees, her little orchard. This season they did not bear fruits. On the rest of the farm, the maize crop has failed due to a prolonged dry spell.
When there is good rains, they grow they are big enough.
Indeed, this area has experienced 4 consecutive droughts.
If there is no rain, then it means that we have to go to the market to get food for the family, even for the livestock. It is not very cheap because in the market now the price of food is very high.
Severe weather patterns have pushed families here to poverty, even as both the local and central governments seek ways to cushion them from the effects of climate change. The Kenyan government estimates the drought between 2008 and 2011 amounted to $12.1 billion in losses. When the crop is lost to a drought and the farmers have no money to plant during the next season, ideally they should seek credit from local commercial banks. But
it's a challenge because of climate change. Because now, if they take a loan and they are going to invest, they are not sure that they will be able to harvest enough to be able to pay the loan.
Now development partners are seeking ways of ensuring that farmers have loans that are insured against risks like these past droughts under a scheme dubbed the Risk Contingent Credit scheme.
First, it is a loan, but with the loan, they have an insurance part of it. So in case everything is going well, it's a regular loan, you have to return the loan to the bankers. But if things go back, it's not your fault, it's because of the weather. So actually, because, no rainfall, your crops fails. So in that case, the insurance company, this is where the insurance part comes in. The insurance it's not you pay back the loan, the insurance company will pay back the loan on your behalf to the bank.
After undergoing training on agronomy as well as financial literacy, participating farmers receive vouchers to buy seeds and fertilizers. Unlike the traditional index insurance schemes, which use data from the whole season to compensate farmers, under this scheme, payment is done if average rainfall is too low in any 21-day period throughout the growing season.
When we assessed why the farmers were not able to pay the loans, it was actually because of the way the insurance product was developed on the basis of the cumulative amount of rainfall as opposed to the distribution. Because in farming, if you have a lot of rain at the beginning of the season and then there is no rain in the middle of the crop growth and towards the end, then the farmers will not be able to harvest. So for this particular one, the learning we picked was that when you're looking at rainfall, you don't look at one point in time, you look at the distribution throughout the season.
Beatrice benefited from the first loan when the season was bad. This time, however, she was not worried that she has to sell her cow to repay the loan. The insurance stood in the gap.
I'm very ready to get loan so that if it rains well, I could be getting enough food for my family and also to take to the market to get money.
If it proves commercially viable here in Kenya, then to be scaled up to other parts of the continent.
For example, Tanzania, this maybe, is other. Remember, we are talking about this area is semi-arid or even arid area, which is very risky for the bankers. Normally, they don't want to give any loans to these farmers.
Helping farmers in Africa to adapt to the effects of global warming. For a long time, commercial banks in Africa have considered farming to be a very risky business, and therefore they do not offer farmers like Beatrice loans to conduct that business. The risky contingency plan is supposed to cushion farmers like her from the effects of climate change when they take out loans. Sarah Kimani, SABC News in Machakos County, Kenya.